Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
Great to be here. Firstly, I just want to say thank you to Roger, for organizing this, great event. This is, I think, now my third M&A Advisor event, and it's just got a great vibe, great people, a combination of investors, additional resources and such. It's just a really good event. So appreciate that, Roger. And also Steve Finney, I have him on speed dial, and he's always been super helpful whenever we have questions, and we're thankful that we're able to sponsor this event. So before we jump in, I just wanted to tell a quick story about how John Kelemen and I had met close to 10 years ago. John is a deal maker. He's a private equity investor, and he and I had met at a firm down in Washington or in Virginia about 10 years ago. And John and I had the opportunity to work on a wholesale educational resources business and manufacturing operation out in Kansas. And what always impressed me about John was just his rigor, humility, his deep market insight, his knowledge, his education, and how he approached each and every deal, and how he worked with the management teams of the portfolio companies, how he interacted with the resources like ourselves, whether it be legal, accounting, insurance, cyber, technology, and such. And he's made a real impression. And so when I asked John if he was able to join us today, just to give his insights on investing, he was, happy to do it. And given that you have your annual meeting tomorrow, I think it is, taking a couple hours out of the day is really appreciated. So thank you for that, John. And then if I can kind of frame this discussion in terms of where John and I are going to take this conversation. All of us have seen, the deal environment and how it's shifted, valuations resetting, lenders tightening, selectivity. So we want to just address all these issues and find out from the Beekman Group, what are they investing in, how are they investing, and how are they kind of seeing the marketplace. And then let me just share with you a little bit about John's background, because I think you'll appreciate that as well. So John is currently, as I mentioned, Managing Director of the Beekman Group right here in New York City. He has over 13 years of private equity investing experience. John is responsible for sourcing, evaluating, executing, monitoring investments within the healthcare and business services sectors. John is on the board of Riva Air Ambulance. He's on the board of Allergy and ENT Associates, Fluent Dental, and Campus Eye. So he's a pretty busy guy. And prior to joining Beekman in 2019, John was with Gladstone down in Northern Virginia, as I had mentioned, a middle market private equity firm. And prior to that, John began his career at Paul Capital Partners, where he focused on private equity secondaries. So from here, John, if you could just give us an overview of Beekman Group and kind of, what your firm is about, what you're looking at, and maybe just give the audience a little color on the firm.
Yeah, sure, absolutely. Thanks, Mark. So the Beekman Group, we're a lower middle market private equity fund. We're based here in New York City, outside of Bryant Park. We have about 1.2 billion of AUM, and we're now deploying our fifth fund, which will be around 350 million, which we'll finish up the fundraising at the end of the year. As a firm, we focus on three broad sectors: business services, consumer services, and healthcare services. Think enterprise values 50 to 150, kind of on average, and kind of our typical check size on the equity side is about 40 million. We do a lot of buy and build type investments, so it's not uncommon for us to kind of start at the 25 million of equity and kind of build over time. As you mentioned, I focus on healthcare services at the firm. So for us, what that means is we do a number of transactions in the provider space. So dental, ophthalmology, allergy, kind of traditional provider roll-ups, as well as healthcare technology and healthcare outsourced services. So that's kind of my lane. And then I have three other partners that focus on business services and consumer. And just to kind of give the audience a flavor of our portfolio, we on the consumer side, we have a large Dunkin' Donuts franchisee. It's doing about 20 of EBITDA. We have a large Planet Fitness franchisee. We have a franchisor of a restaurant concept called Another Broken Egg. On the business services side, we have two auto software companies. One's in market, but two right now. And most recently, we sold a commercial security alarm business. And then again, on the healthcare side, kind of a variety of provider deals, and then one healthcare technology business, and then obviously kind of our one air ambulance company. But happy to be here, and happy to dig in.
Yeah, no, that's really cool. And just one comment you just made there too, just with regard to fundraising, maybe just touch on that just quickly. How difficult is fundraising these days, or not?
Yeah, look, fundraising is a challenge. I mean, I think we all follow the news. I think LPs in general are very focused on distributions. And the private equity cycle, the deal volume has definitely slowed the last couple of years. So distributions is the name of the game, and we've been very fortunate to have had a number of exits over the last couple of years to kind of return capital back to the LPs. But that's the focus, and I think that's where most private equity is really kind of digging in to try to monetize assets.
Yep. No, and listen, I'm a huge fan of the middle market, lower middle market. It's a great space. Talk to me a little bit about the current deal environment. What's changed in, say, the last 12, 18 months? And when I ask that question, I also think about what's changed in the last 5 years. I remember, for example, about this time 5 years ago, call it 2021, you called me up, you said, Mark, we have a deal. We need to get this thing closed by the end of December, and we need rep and warranty, et cetera, et cetera. And, the market, in fact, at that point in time, rep and warranty market had really dried up because there was just not enough capacity and such. So that environment then compared to today.
Yeah, look, I mean, definitely the volume, and we all know this, the deal volume is down off the peak of 21. It definitely has rebounded, in the last couple of years. Our focus on founder-owned businesses does mean that we do have a good steady flow. But I think a couple of things that have changed in the last couple of years. I think one is multiples are definitely down kind of across the board, but in our opinion, they're back to a more reasonable level, back to historical norms, which is positive. In the last couple years, a lot of our investment banker friends got very creative with what's EBITDA, with pro formas and run rates. That's now coming back down to earth to kind of more cash flow type metrics, which is good. It's more rational buying. And I think buyers are much more focused today on organic growth stories. Deals that got done a couple of years ago that were all M&A driven growth, those are harder to get done these days. I think the investor community wants to see kind of what's the organic story within the assets. And I think if you kind of check those boxes, deals are getting done. Obviously, there's some subsectors today that are more challenged than others, but there's certainly a lot of opportunity, and we're very busy. We have two deals, for example, under LOI that we would expect to close, one this year and one in kind of Q1 next year. But definitely kind of, again, multiples are down. I think quality of EBITDA is up, which is positive, and just more scrutiny, certainly, on the diligence process.
Yeah, Cool. And just maybe just touch a little bit on the lending environment. What is it like? When you're doing. I know you guys you take control positions on every deal. So, in terms of going out there and raising the debt part of it.
Yeah. So our firm will typically do the lending outreach directly from our deal team. So me and my associate and VPs will outreach to direct lenders or commercial lenders. We as a firm tend to lean a little bit more towards commercial lenders and take and kind of trade lower rate with kind of higher amort, or that's just sort of more of our investment style. In general, we are finding that there is plenty of debt capacity out there. I mean, the direct lenders have raised a lot of capital, so we are not finding that as a real issue. And but where lenders are digging in, same as us, is on, again, the quality of the earnings, a lot of scrutiny on add backs, and just how durable the business is to kind of support leverage levels. But by and large, I think the lending community is pretty supportive, which definitely I think portends positively for kind of more deal activity in 25 and 26.
Okay. Yeah, sounds positive. Now, for those in the audience who are not familiar, that familiar with the private equity investing, there are what we call A assets, and then there's everything else. So maybe just talk a little bit about the A assets versus everything else, and kind of what you're thinking about in terms of either targeting the A assets or the everything else type assets, and how you're going about that process.
Yeah. So we've sold 5 companies in the last 3 years, 2 healthcare and 3 business services, all at cash on cash MOICs of over 4 times. So we've been lucky there. Definitely the A companies, and A companies I say that are companies that have good organic growth stories, good management teams, kind of an underwritable growth story, low adjustments, durable demand drivers. Buyers are definitely stepping up and paying up for those assets. Those processes are running fast. You can really push buyers to kind of do work early, do QofEs, really dig in and lean in, and get attractive outcomes. So that's definitely happening. It's certainly on the B, which these aren't bad companies. These are just companies that maybe have a little hair on them or aren't perfect. These are the ones that just take longer to get done. So you'll find your sale process just drags out. And what that means is suddenly now you have a company under the spotlight for much longer. So they got to perform. They got to actually hit their numbers for longer. And oftentimes what we're seeing in this market is when you get to that LOI stage, you don't have 2 or 3 groups that are driving that competitive tension to get that outsized bid. You're still getting market clearing prices, but you can't always drive that outsized bid. So that's the difference I think that we've seen. But certainly there are more challenges selling the B assets and just frankly being real with yourselves that you're not going to get the same multiple that you got 4 years ago. In 2021, where that spread was a little tighter.
Yeah, no, interesting. And from an A asset, say, versus B asset perspective, do you often see would it be a rule of thumb where an A asset, if it's a great company and just have so much potential, you see that as a platform type opportunity where in some cases the B assets, they got some hair, but there's also a lot of potential there too, where you could see that as a platform or potentially add on to an existing portfolio? Or is it, how do you see that?
Yeah, I would say for the B assets, and obviously we love all our children, we love all our companies, they're all great. But when you take them out to market, the ones that are not clear-cut A's, you definitely see more strategic interest kind of providing a floor valuation. So the strategics can really be competitive in those markets, because I think private equity now is again very critical and skittish if there's any sort of issues, where the strategics can kind of buy into more of the strategic value of the add-on. So for sure, I mean I think that's a fair observation, Mark.
Yep. No, that's cool. And then the other question, and not to spend too much time on it, but I'm always curious, when the investment bankers and the third parties are bringing deals to you, right? How many of them? I mean, do you look at all of them? Do you look at some of them? And at the end of the day, how many of those deals that come across your desk do you say, wow, this is a pretty great opportunity for us?
Yeah, so we'll probably turn away after getting the SIM or the SIP now, it's called, 75 or 80% of deals just kind of off the bat. Either it's not the right sector, not the right size, not the right profile for us. So we do try to kind of pick our spots, and I think you are seeing this in private equity. Kind of broadly speaking, people are being more selective about when they engage on an asset. So I think the number of IOIs that you'll see is definitely down. As again, people want to feel like they have a good right to win certain things, and it's in their sweet spot, and they just don't really want to waste time chasing things that maybe aren't actionable or aren't kind of right down the fairway for them. But broadly speaking, healthcare, where I focus, I think bankers would tell us that maybe 50% of deals that get launched ultimately get done. So there's definitely, not everything that's in market, so it's always getting done, these days. So we track that, and when it comes back around, we kind of leverage all the info that we had before to hopefully be more competitive.
Yep. And I think you've kind of answered this already, but just, microspectively speaking, when you're looking at deals now for your portfolio, the fundamentals in there, you had mentioned, EBITDA, valuations, top line revenue, headcount, whatever. What's kind of like the perfect or the ideal profile situation?
So for us, if you're talking platforms, because we are partnering with founders, we're typically asking the management and founder team to roll over alongside us in a 20 to 40% stake. So that alignment is really important for us. We are looking for consistency historically as well as consistency going forward. So we talk a lot about internally about projecting the go-forward performance to look very similar to what they've done before, and just try to be really conservative there. We try to find companies that have an M&A or roll-up thesis around it. Almost all of our companies are doing add-on acquisitions to grow, so that's really important. So defining that playbook with management at the onset is critical, so that we're aligned that, hey, what are we going to do with the asset after we buy it? That's one of the ways that we add value, is we really drive that add-on acquisition. And yeah, just again, being kind of a good, steady demand drivers with not a big disruption risk kind of going forward are key things for us.
And then, so you're under LOI, you're looking to, close on a company. Just kind of walk us through the diligence. You've got quality of earnings, you've got legal, you've got environmental, insurance, et cetera. Has that changed, or?
Hasn't changed. I would say we're certainly getting more time to get diligence done. So it's not as rushed as it was in 21, 22, which is good for us as a buyer. I think quality of earnings continues to be probably the most important thing, just to validate that the cash flow is what we really believe it is. On the healthcare side, my focus, we spend a lot of time on regulatory and reimbursement, in particular any kind of company that's taking managed care risk or billing the government. Just, there's obviously a lot of disruption happening in healthcare, so we spend a lot of time focused on that. And then more up your wheelhouse and kind of on the insurance side, not at the deal side, but the portco level, we're just seeing a lot of cost pressures on the health insurance side. So we really try to kind of mitigate that with you guys and other brokers to kind of really manage our costs at the portco level.
Yeah, and obviously we've learned over the years working with deal guys like yourselves. We definitely have the word EBITDA. That's kind of attached to our mindset. But with health insurance, that's not my area. My firm does a lot of the health insurance. Obviously, we've been trying to find creative ways to put cost-cutting measures into healthcare insurance. It's not easy to do. When you're looking at those costs are up 5, 10, 15, 20%, year over year. We had a circumstance very recently where manufacturing operation with like 250 headcount, whatever it was, the total insurance healthcare costs were like $2 million for 2025, and projected for 2026 are going to go from $2 million to $3 million, right? So the operating partners didn't want to hear that, and we found some interesting ways to put in these ICRA programs to kind of pull the costs back, and I think you'll start to see some more of that in the marketplace, for sure.
Yeah.
And then with regard to your investment committee internally, your diligence looking at your deals, you looking to win the deal. Sometimes I'm sure it's a competitive environment. And these management teams that are running these, portfolio investments have great opportunities, and they're like, okay, I'd love to work with Beekman, or I've got somebody else out there talking to me too. How do you guys work through that process with the management teams?
So for us, it's all about, like, you're only going to win an asset if you have conviction behind the sector or the management team. So we do a lot of work up front, identifying subsectors that are interesting for us that we like. So what does that mean kind of in practice? So right now, our business services guys are focused on filtration, that's either manufacturing or distribution. So we're trying to find a deal within filtration, we're trying to find deals within software, and then within healthcare, I'm trying to find transactions in kind of healthcare technology or outsourced services to the outpatient or the ambulatory setting. So once you define where the lane is, that's really just, finding the opportunities and then really selling yourself to management. Our model is partnering with management teams where they're owning 30 to 40% alongside us. So we not only need to pay the highest price or near the highest price, but we, more importantly, need to convince the management team that we can help them achieve that next leg of growth so that their rollover can be worth significantly more than the money that they're making, kind of at our deal. So what that means in practice is there's a lot of dinners, meetings, rapport building on the culture side, but more importantly is just defining the post-close value creation plan collaboratively with management so that they feel like comfortable and no surprises post-close as to, do we need to hire a CFO? Do we need to, what's the M&A roadmap look like, for example? So those are the things that we really try to focus on to kind of win the deal. And then, something that we haven't talked about is just in this market, there's a lot more emphasis on structure. And this is a way to kind of bridge the gap a little bit with sellers. So if someone has in their mind that they want to get a certain multiple because they want to tell their country club buddies that they sold their company for X multiple, we can deliver that with maybe some more downside protection. So you can do earnouts, you can do holdbacks, you can do preferreds. So there's other mechanisms to kind of bridge the gap there to kind of deliver that headline value while also protecting our downside, which is not something that we really saw in 3-4 years ago. That was something more back 2018 and before, which is certainly positive and kind of more healthy in the current market.
No, that's fantastic, and I'm sure there's a lot of questions that you all want to ask John. He'll be available for a few minutes. I know he's got to get back for his annual meeting preparation, but we don't want to take any more time here and let the next team get prepared for their presentation. But John, I can't thank you enough for making the effort to be here to talk about these topics. I could talk to you for another hour. I mean, it's just really cool stuff, and thank you very much.
Great, thanks, Mark.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.